Peter Goodburn, my trading warrior brother. Welcome back to F.A.C.E. How are you,
Great.
Peter?
Thanks, Dale. Thank you very much for inviting me, guys. Blake and Steve. Hi, good morning to everybody.
Hey, mate. Hello.
Good morning.
How you doing, Dale?
Kumbaya, kumbaya.
Yeah.
Anyway, Peter, really looking forward to your analysis at this, kind of time zone that we're in with a lot of inflection points. Feel like they're close. You want to share your screen and tell us what's top of mind for you right now?
Let's have a look. I think there's plenty of situations going on here, really. I mean, in a way.
Peter and I just got back from Woodstock.
I beg your pardon?
We just got back from Woodstock.
From Woodstock?
Because of our
Really?
long hair. Woodstock, the rock festival.
Ah, yeah, I know what Woodstock is. You mean
anyway.
you think I've just got back from Woodstock? Oh, okay. Yeah, well, this is my anti sort of pandemic sort of look.
Hey, you look like a wizard.
I'm a changed man.
So all right, was this week's sell-off, because we're having a recovery today in S&P? Was this week's sell-off enough to, what you say, give us a reversal signature to the downside?
Well, we've had a reversal signature to the downside on equities actually for a little while now, because we've just seen a lot of disparity in the different sort of makeup of the markets, the different sectors, and there's been a lot of rotation. I mean, if we go back, if we have a look at, say, for example, the Dow Jones. Can you see my screen okay, by the way?
Yes, we've got it.
Good, great. If you look at the Dow, in its corrective decline that began from the Jan 22 high,
right?
We can see a replication as a zigzag downswing into the June low last year. And then the corrective process that followed, which is basically wave X, it's the sort of intervening pattern in a double zigzag decline. And wave X in this case was an expanding flat. So we go up into August, down into October. We get a 5-wave look up into the December high at this 34,000 number, 34.7. And actually, so that pattern actually finished in December. So that was giving us a sell signal back then. And
right.
And then you sort of flip and look at the S&P by comparison.
And it was making higher highs.
We're only just sort of like, well, we finished maybe in February. And of course there was basically a 2-month lag, between December and February. So here's the December high that the top of is confirmed in the Dow, and here we are in February. We haven't broken that yet. probably now, after seeing yesterday's action, probably unlikely to break that high.
Okay, is that why you kind of have it faded out? The potential count to 43.27 becomes,
well, I wasn't certain,
less likely.
Yeah, I think before yesterday's session, I wasn't certain if we could manage a bit more oomph to the upside. But it's looking increasingly less likely that we'll manage to do that now. If you take a look at the very short-term picture, you can see that yesterday's decline, we started to expand the price relative to the first downswing here. So this is the Tuesday, the week before. So that's the mid-April high at 41.98.25. And you can see that the extra additional sort of sequence down yesterday rather expanded the price action relative to the initial first wave. So that makes it look like a third. Now, sometimes in Elliott wave, and one of the most difficult things about applying Elliott wave are these corrections, because sometimes in a zigzag environment where you get 3 price swings declining, say, for example, like this, sometimes you get a disproportionate C wave. It's rather elongated relative to the first wave or the A wave. And that's really difficult because they can basically masquerade. They look like a third wave, but they're not. So you've got to be a bit careful. So we haven't quite got to a point where the S&P is really set in stone that it's going to drop from that secondary high at 41.98.
We need closes under 4K to really seal the deal.
Well, I think the main importance here is the pattern itself. I mean, you can see it struggled in this rally overnight.
Yeah.
If that were to sort of complete a fourth wave and then come down in a fifth, so the pattern is going to
Okay.
change, and we get
And then
down
have
to
a
something.
then have an ABC type recovery.
Yeah, but then we got 5 waves down, you see, and there's no way
Yeah.
then it would go back above 41.98. Yeah, we get a rally to sell into again, but
Okay.
you know, you can be pretty confident about the direction. So that's the only sort of situation. But I just say this because you know, I suppose if you look at probability issues, that could be a zigzag with an elongated C wave, and we try and trip up to slightly higher high, which would look like this. Then you get up to 42.12, but I think probably not, because if you take a look at the Nasdaq, for example, by comparison, yeah, we've got about a 1.5–2% upswing in this rally. The main reason is that when the S&P dropped down from last week's high, which is basically here at 13,298, it's dropped down in only 3 waves, not 5. And when the S&P continued down a little bit lower yesterday, this just made a secondary low. You can see the sort of, it was a bit like a bullish divergence.
Yeah.
You know, because this one didn't make a slightly lower low, and this one is capable. Well, it's isolated.
And that's where all the earnings are. That's where all the earnings are coming in pretty positive. Microsoft knocked the cover off the ball, and Meta, and who knows, Apple probably will next week because I'm in puts. So
yeah.
Anyway, the tech,
that was it. Yeah.
The big sell-off, the real weakness were in things like cat and deer. They've been declining for a while, and the semiconductors, I don't think will make a new high. You track the semis here, Peter?
Yeah, I think we've got semiconductors here in the sectors. Yeah, I think that's
Until I see your chart, then I think they might be able to. No, well, they could challenge your recent high.
Yeah, well,
that's a big break into July.
Yeah, this is really starting to look very bearish indeed. A lot of the sectors, again, some of them actually, some of the sectors topped out in January. You know, things like I think, if I'm not mistaken, things like healthcare, maybe consumer staples, stuff like that. Others topped out in February. And this one,
you
of
know,
course,
Apple is the only FANG or MAGA stock that really hasn't corrected through 2022. And you know, Peter, people think it's as safe as a CD or a bond, and it's the gold standard of stocks and an icon of America. Don't you think it's the most crowded trade on the books out there? Long Apple. I mean, you know, Steve is normally bearish. Okay, Steve, are you here? Okay, and I'm talking about Apple.
I am here, mate.
And I could be wrong, but here's a guy that's really bearish, and you know what he says about Apple? It's a good company. So even stock bears can't get bearish Apple. That's my point. I was thinking about that yesterday, Steve.
Well,
go ahead. What do you think about that?
Caps? Well, actually, this is an old chart that I drew, obviously, earlier this year, about 6 weeks ago. And I had an upside. I knew it was going to have another rally. I had a target at 169. And if I remove my chart, because I can't see it properly, so I'm just going to remove what I drew back then, just to see where the top is. Let's have a look. I got to, what's that, 168.16?
Yeah, it could still go to 69 if we have one more rally in Nasdaq.
Yeah, I mean, from a pattern point of view, it doesn't need to. I mean, that's pretty much done. It's business.
Yeah.
So you've got huge downside potential here. I mean, so this is again a sort of an archetypal double zigzag, which you're seeing in the Dow, the S&P, Nasdaq from last year's highs. So you got ABC down here, and then you got this rather fluid expand. Well, the Dow was an expanding flat. The Nasdaq was a running flat. This one's technically a running flat. You can see I've sort of marked it up here as a running flat, because basically you've got this rally, counter trend rally. You got this very distinct 3 price swings that break slightly down into lower lows, and then it whipsaws back up, which is typical of the running or the expanding flat pattern. But this one, because the A wave was so deep as a retracement of the preceding zigzag,
Yeah.
and you've broken the previous low, sometimes it's very difficult to complete an expanding flat, which would require a slight break above here, just a couple of pips, but not above 182.94, and then drop. It's going to be too much for it. So we thought, yeah, a running flat seems appropriate, and we took 100% of wave A to wave C, and that's how we got that target. It looks to me as if it's done, so we've got huge downside potential for Apple now, which is, you know, if anybody listening in or watching, and you know, it's a really good idea to sort of, you know, take your chips off the table now and walk away.
Something.
Have a beer or something, you know, wait for it to drop.
They won't. In fact, you know, I wouldn't be surprised if on the last couple days with other issues under pressure that they rotate in. They're still rotating into Apple. Okay, I'm nervous about the market. I'll just buy Apple. It's a good stock. It's a good company.
That's what they're doing.
You know, and you know. Anyway, let's get back to your stuff. And God, that really is thanks for giving me hope today. And let's talk about the dollar, Peter, because it's you know, either completing or there's one more wash. What's your bias? Okay, there it is.
Well, yeah, this is quite fascinating because during the decline from September's high, you know, we were up at 114.78 at the time. We've had a nice 5-wave decline into February's low, 182. Yeah. And, you know, ordinarily when we update these types of markets, we say, right, well, we'll give it the benefit of the doubt. We tend to default a correction into a zigzag. So, you know, at the very early beginning of a counter trend rally, we draw that. But as time went by, it became obvious this wasn't going to do a zigzag. We had 3 waves up here, for example. So I suppose it could have been a double zigzag and you have an X wave pullback that doesn't break the low.
But you're going to get an irregular ABC.
But yeah, but this is actually describing an expanding flat pattern.
Okay.
And this downswing from this early March high down here, if I go to my worksheets, which is my sort of sketchboard for analysis, and show you what the dollar index is doing, here's the decline from that high. And it's actually unfolding into a double zigzag pattern, which is really cool. It's ABC down here. If you extend wave A by 60.18, you get really nicely into the C wave low. So that's a pretty good measurement in order to validate the zigzag completion. We then had a bit of a quirky running flat pattern in wave X. It's very definable with 3 waves breaking down and the 5-wave rally again. So you see this in Apple just now. Same running flat pattern, but different time frame, different market, but same pattern sequence. And then if you extend the first zigzag by 60.18, you get down to 99.5, specifically this number, 99.53. And if you cut that by the golden section, so you create a golden section, in other words, you measure from there down to that measurement, and you cut it by the golden ratio here, you get wave A of the secondary zigzag. So B is tossing around here, and it's in a bit of a range trade. There's nothing really to do from a trading point of view because, excuse me, there's no risk reward or anything.
Okay,
that's viable. Right. So you just let it go. But this is really, you know, good. I mean, look, if it popped up there, you can trade it short, put a stop above there, and take it down. But otherwise, just let it down here to 99.50.
Probably the smartest thing is to wait for it to get to targets and then look for, you know, even let the first wave happen without you and then buy a correction.
That's right. Well, I think that what you've what's going to happen here is that if we get down to 99.5, so let's go back to the bigger picture. This is it down here. You should see gold
peak.
Complete. Well, gold's already peaked. You know, if we inversely, this is the dollar technically from an Elliott perspective bottomed earlier in February, and this extra downswing is wave B of the expanding flat. It's been giving gold a bit of an extra flip to the upside, but they're naturally inverted correlated. But you can see that gold's already topped out earlier this month.
So a new low in the dollar, but a failing rally in gold.
a failing rally in gold. Gold needs to trade up to 2025, 2030 or something like that, whilst the dollar goes down to 99.50. And then they should, the dollar will start to appreciate going to the upside, and then gold will resume this correction down. I mean, I've been very modest in this correction down. If anybody's interested in gold and looking at this, the 1820 number is just a 50% retracement of the preceding upswing from impulse upswing from September. Ordinarily, Elliott sort of said that, well, there's a tendency for corrections after a 5-wave pattern to retrace back to wave 4 preceding, which is why the 50% number comes in. But I'm interested in this downswing. That's the first wave of wave A. If you extend that by 1618, you'll get to numbers actually lower than these suggest. So these are sort of minimum criteria. But if you've been fortunate enough to take in the gold rally from September up, it's time to come out now and give it a rest. If you're very active and aggressive, you can go short. I'm sort of shorting the market on the next rallies. But generally speaking, this is dovetailing with the dollar expectancy of this pickup. So you can actually verify the low at 99.50 by just taking a quick look at gold. It should have finished a counter trend rally of something there. And I think also by the time the dollar hits 99.50, I think treasury yields and bond yields should be ready for the next decline.
Okay, so yields rally while the dollar makes new lows.
Yeah, I think we're getting ready for. I mean, if
I do see a disparity when I look at like TLT, which is 20-year proxy. It looks so much worse than like the 10-year yield. Oh,
yeah,
okay,
I mean, this is TLT, and
yeah. So what? Yeah, so I
got
mean,
to get up here to about 113.25, I think.
Okay, all right.
It's got to get up
I thought
there,
that might happen with risk off, but maybe not.
Well, I think as soon as the dollar goes bid, you're going to get the next phase of stock market declines, aren't you?
Right, and everything. Peter, do you believe, and I know you cover like how many instruments and markets you cover in your research? Give me an approximation.
Oh, I don't know, maybe a couple of hundred.
All right. Do you believe this statement? If you can get the dollar right, you can get all the markets right.
Absolutely.
Okay. All one market?
Yeah. I mean, generally speaking,
and then it's degrees. Like you called the platinum that was going to become the outperformer 3 months ago, and that certainly was right. I mean, there's all kinds of breakouts that occurred in platinum, but
yeah, well, platinum is it's done pretty well. I think it's going to have this pull back downwards. Probably this is an expanding flat pattern, but in the bigger picture, platinum is going to be a big outperformer anyway, because we can see that looking at the ratio relationship also between platinum and gold, platinum silver, that platinum's going to be the big one. And I don't know why that is necessarily. I mean, don't forget historically, in latter years, in before years, we've had platinum always premium to gold. Yeah. So this is a bit of a novel thing for our generation to see platinum as a precious metal.
We've seen a lot of novel things, like the novel coronavirus and novel.
But anyways, I mean, for those that want to be long of gold in the next turn up, once we've seen this correction down occur, you've got to. I thought, well, silver's going to be outperforming, because of the gold-silver ratio. Silver's going to outperform gold, but actually platinum will outperform silver. So if you're really interested in trading these ratios, you've got to really start thinking about sort of platinum. I think here's the platinum gold ratio. Let's have a quick
long
look.
Platinum, short gold on the spread.
I mean, look at this. This is going back to the 1930s.
Yeah.
And you can see how, platinum now is so undervalued relative to gold. This spread will completely contract, which means platinum will outperform. And over a very long-term period, we're talking about this decline coming through to reflect gold's weakness against platinum. So platinum is going to be a huge, huge outperformer. So don't. And if you can't do that, funny enough, I was speaking to some clients about this, and they said, "Oh, we're going to stick to gold. We're sort of." They're just typical gold bugs. You know, they like the flavor of gold and stuff. And even
Are
if
there
the other
any
product,
platinum shares that you trade? Platinum
um,
shares?
I think you asked me this last time, and
I
I
probably
struggled to
did.
answer, didn't I?
Yeah.
Yeah. So why are you asking me again?
I forgot that I asked you.
You're putting me in the hot
Till
seat
you,
now.
I thought when it was coming out of my mouth, Peter, I go, I think
I think I'm tracking Impala or something like that, but I'm not. I'm a bit worried because
you know,
sometimes my data vendor is not
I,
updating stuff real time, and I have to sort of put this in by hand to measure all the stuff. So I'll have to come back to you on that one.
all right.
Next
Okay.
time we meet, I'm going to have something prepared for you. There we are.
Okay. Anything else that you'd like to clue us in on? I think we really ran the gamut.
Well, I have
Any
to say
specials?
that on the thing that's really interesting me is the way that treasury yields are working at the moment.
Yeah. Yeah.
Mainly because everybody's basically, if you look at the bond market figures and some of the traders coming out from some of the sentiment numbers coming out from the surveys on bond
Oh,
markets.
you mean like huge? I think you have one of the largest net short positions in bonds on the Commitment of Traders report.
Yeah,
So
and
they're short. So if your bond count is right, they get squeezed out
yeah, I
first.
mean, that could switch around down here. I mean, we've got the thing that's worrying me is that when we take a look at the bigger picture, go back to the pandemic low, which is just off to my left here. It's about 37 basis points.
Yeah.
You count up this whole swing up, doesn't look like it's finished 5 waves to me.
Yeah.
I think
This
we
is a
got at
4.
best the 3rd wave last October, and this is a 4th wave.
Yeah.
I don't think people are positioning in. They won't be positioning
No.
in for that. I don't think.
They're positioned for 308, but I'm hearing people talk 2.5%, 2%,
Yeah.
10-year yields. They're not. The market isn't embracing new highs in yields by.
No, and it sounds reasonable actually if you think about it, because I mean if the stock market's going to go down 30-40%, which is our forecast for this year from around current levels. I mean, I'll just toddle with the FANGs index just briefly to show you what the FANGs looks like here. This is the same zigzag decline as all the others last year, and then this expanding flat, 3 up, 3 down, 5 waves up to complete the expanding flat, hit the highs in earlier this month, and that's already starting to turn down. So this is about a 40% drop. This is big. This is the FANGs index. That's why you're going to get smashed on Apple and stuff like that.
Yeah, because it's been the only part of FANG that's held up.
Yeah,
that
exactly.
Almost broke out to the upside. Well, all of these are the rest are putting in failing rallies.
They're all sort of failing as well. Yeah.
Yeah.
But what's really interesting, if you've got a 40% drop like that, or let's say 30% on the major indices, you'd expect the yields to collapse lower. So I can understand why people in their minds just think, okay, maybe the 10-year yield can trade down to 2.5% on that basis. Yeah, that's but I just don't think it's going to happen, because this 5-wave pattern from pandemic hasn't finished. And so far, the proportionate relationships in 5 waves down here into the 340 number, that was late December. And the 5-wave pattern that's followed from 408 down to here, which is this one, is certainly proportional to finishing a zigzag at 308, 309. And if that's a zigzag, and this pattern hasn't completed, then this is going to have one more big push. We can see it actually by doing a comparison with Italian bond yields. Now, here in Europe, the BTP yields are really important because, Italy is a bit of a major hub. And it's come under scrutiny, Italy, in the past because of its funding program, its GDP to debt ratios, this type of thing. And all the banks, the tier 1 banks here in Europe, continental Europe, that is, they're all trading BTP. They've all got a huge BTP Bund spread book. Okay. And if you take a look at the Bund spread book, the BTP Bund spread book, and you also take a look at the way in which the outright yields are trading for the BTP yields, you'll see that that also is missing one leg to the upside. There's going to be a big push up to 6%. At some point. And this is also indicative of the Treasury yields coming down to 308, 309, and then having another push up in the fifth wave.
Yeah.
So we've got a
Okay.
lot of compounded evidence
Yeah.
that on the bund yields as well. Here's the bund yields trending up. So anybody trading bonds over the next month or two, I think the yields will drop. So we get the Treasury yields down to 308. The bund yields will drop down to 179. So in fact, that is suggesting that we get some safe haven bond buying. So it's going to pull the yields down when the stock market has its next thrust to the downside. But I think at some stage later, there's going to be some exogenous piece of news. Either its core inflation is still persisting and the central banks suddenly change their theme. Because these yields these 10-year yields are going to be going up into slightly higher highs. Not necessarily the case on the 2 years. But anyway, this is a bit complex for people, maybe.
Yeah, maybe it's has something to do with the debt ceiling. I actually saw someone saying that it becomes deflationary once they do raise the debt ceiling, because then all the money flows into Treasury, sucks liquidity out of the market and the economy, because the Fed is taking that liquidity now, once the government, by issuing debt. We could get a downgrade if they can't come together and pass anything. It could be chaotic this time.
Yeah, I mean, we're used to talking about the debt ceiling, every year, aren't we?
Yeah.
And they kick the can down the road all the time.
A lot of complacency about it so far. There'll be
theatrics,
but it'll get done.
Yeah, right? I mean, everybody thinks that all the time, and there could be a glitch. I don't think you're not going to see the government go bankrupt. I don't think this is the right timing of that bigger cycle, where we've got an inflation pop cycle still running. And after these equity declines this year, by the way, for everybody watching and tuning in, after we see the equity declines, we're going to see another big bubble. The S&P and all the major indices are going to make higher highs.
Can I ask you this, Peter? Because, I interview people that are looking for a melt up to new highs. And then I think about your count. And you're basically the same, except there's one more shoe to drop to clean out the people who thought we had a bottom last October. And then the melt up happens. What are they missing that they think wave 4 ended at the October low, and that and the melt up is in progress now?
Well, I mean, you're talking really from an Elliott perspective or a fundamental basis. Yeah, I mean, Elliott.
They're Elliotticians.
Oh, okay.
These guys. So, I mean.
Well, that's news to me. I tell you why. I mean, I don't look at the platforms too much about what other people are doing, but I mean, one of my clients did tell me that there was a group out there who are saying that there's going to be an Armageddon collapse.
Oh yeah, that's Prechter.
Oh, okay, that was Prechter, was it?
Yeah.
Okay, well, he's a perma bear always, isn't he? But,
right. Yeah.
So you're telling me there's others who think that October was a major low and then we're going up again, right?
Yeah.
Well, I mean, we had a look at these expanding flat patterns. Maybe they think that there's 5 waves up here, which there is. I mean, this is a 5-wave diagonal in the S&P. And if you go back to look at the FANGs index, where are we here? You can see 5 waves up from October as well.
Because no one's going to want to buy the S&P. No one's going to want to buy the S&P at 3,000 down there after they take the October lows out.
Exactly. So that's when that comes out. But as far as commenting on what you just said, I can only assume that they're looking at, they're not paying attention to this pattern and what it really is, and saying, well, that 5-wave advance on the FANGs, and there might be 1 or 2 others, is part of a new uptrend. But it doesn't make sense, because if you're going to say that October was a major low and this was part of a new uptrend, how do you count this swing down? Well, we've got strict, pretty neat evidence that that's an incomplete double zigzag. Why? Because if you measure, and I've just put my Fibonacci ratio to measure 100%. If you measure that initial downswing, okay, and pull it up to the correction that follows, bang. I mean, there's 100% equality in those 2 swings down. That's about as much evidence as you need to show that that's a zigzag. Well,
Right.
if you've got a secondary zigzag after the rally, this would become wave X. But where's the secondary zigzag? Doesn't exist. So I mean, okay, you can look through. I can show you 20 different examples like that, which are all much the same. So it doesn't make a lot of sense why you would be bullish from October's low. No, there's going to have to be a break below October's low, wash out everybody, and I mean, it's very interesting now that you mentioned this from others doing Elliott wave, because I wasn't aware of that. And of course, then you've mentioned Bob Prechter's name, so you said that he's a perma bear, and so it looks like we're in the middle of it. You know, we're neither perma bears or perma bulls, but we recognize a 30-40% drop and then new highs. So I think that was, that'll be interesting to see how people adjust later.
Okay. Jane would like to know your count on Bitcoin. We could wrap it with that, Peter, and you could tell people how the best way to follow your excellent work.
Okay, thanks. Well, let's have a look at Flipcoin. Yeah. Actually, this is our last chart that we published in our
wow,
report.
is it getting wild? The action yesterday was
wild.
wild.
Yeah. It picked up. I don't think it's going anywhere fast to the upside, because if you go back to sort of November, we've had 5 waves up, and we've had completion at 31,000, and we've already had an intra-hourly 5-wave drop here. So I think this is just a second wave rally, really. The interesting thing is that when you look at the entire movement of Bitcoin, this is actually an expanding flat pattern, which is just off to the left a bit here. But you have wave A down, B up, which is a very archetype 3-wave rally to 69,000 last November. And then you have 5 waves down here. Now, this is a rather peculiar thing, because each of the downswing legs here, so each of the impulse waves, that's wave 1, this is wave 3, and this is wave 5, technically. I mean, that ordinarily is very unusual, because 3-wave composition in each of the impulse waves is normally associated with an ending diagonal, which would be okay if you had overlap in wave 4 and 1, but there isn't. So this is a bit of a hybrid. So there's a possibility that intermediate wave 4 is finished here, and this 5-wave advance is the beginning of a new trend. But that means, of course, that we're going to have a fairly severe correction. If we get other risk assets being sold off, like stock markets, then Bitcoin, you should allow for a deep correction, at least back to here, maybe a tiny bit more. But I'm saying that because this is such an unusual 5-wave impulse. I think I've got it on this other chart here. Oh, no, I don't know where I've got that, actually. Well, okay, it's here on the weekly chart. And so this is finishing wave 1 at the moment, and wave 2 is coming down. But actually, I can't be certain if that 5-wave advance is proportionately, it can measure as an expanding flat for wave 4.
For 4 with one more low.
And it could go down to 14,000. Well, what does it tell us to do? Well, it tells us not to be, trading too overly aggressive long at the moment, because we're going to get this correction down either way. And we'll see how the pattern diverges, because basis a second wave correction, this would be a zigzag, a 3 price swing event. This one would demand a 5-wave pattern down to a slightly lower low. So I'm not sure which of those two. I'm working off the assumption that this is just going to be a deep correction to us to buy into a secondary low. But I just put this out because I want to make sure that everybody's aware of the risks involved at the moment.
Okay.
But the bigger picture looks pretty bullish.
Yeah, there. Look at his count, 154.
154 eventually.
In a few years.
So I think this looks really good. And yeah, I think that I'm going to give myself a plug now, saying thanks. So this is
look, you subscribe. I see you subscribe to your own letter.
I do. Nothing like eating your own food, that you cook. And so this is wavetrack.com. This is our main page. And if you want to subscribe to a bi-weekly report we put out, it's called Elliott Wave Compass. And just go to the registration subscription level here. And here's the Elliott Wave Compass report. The cost is $39 a month. We publish twice a week, and it shows you a lot of what we've been discussing today. So a lot of the major indices in the US and Europe, and a bit of Asia. And we do about 5 or 6 currencies. We do the fixed income, treasury yields, and bond yields, and we also do gold, silver, and oil. So yeah, take a look, and it would be great to have you aboard.
I've always been a fan of Peter's, and always interested in his work and his creative thinking with Elliott. So check Peter out there, and he's not real active on Twitter, but go to his website, and definitely something in my intelligence gathering.
That would be great.
Yeah, so Peter, really, we ran over. Thank you for giving and giving and giving. Some guy on Twitter, Peter, asked a guy I just interviewed, what's your take on Brent crude? And it wasn't to me. No, I don't know. And I said, what do you do for a living? And do you give it all away? There's something about being in our business that, it's hard work. I know how much time you put into it, and the team puts into it here, and I put a little time into trying to educate and give people good ideas. Yeah, $39. That's what people risk in 30 seconds of FX trading. So anyway, keep it in perspective.
No, thanks, Dale, for explaining that. That's really good of you.
Keep an open mind. Keep an open mind. It'll keep your account open. Don't be stubborn. And my trading warrior brother, Peter, thank you so much.
Thanks, everybody. Thanks to you, Dale, for inviting me again.
Right. Thanks for hanging out and F.A.C.E with us, Peter. Love you, bro.
Yeah, love you too. And we'll catch up soon, hopefully.
All right. Take it easy.
God bless everybody.
All right. That's a wrap, everyone. You can join the team in 6 minutes on the morning edge, and see everyone tomorrow. What's tomorrow? Oh, TGIF. Okay. Don't just count your pips, count your blessings. See you guys tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.